Hello, traders. Guten Tag. Bonjour à tous. Shalom. Salam alaikum. All that good stuff. It's 8 a.m. Chicago time on Tuesday, the 5th of November, 2019. Thanks for being here once again today as we gather to look at the markets yet again. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. Currently, the market is on a slight risk-on bent. The leader in the group is crude oil, up 1%, up 57 cents. Crude is trading right on top of its composite point of control from way back, and is holding steady there. The point of control yesterday in crude was on top of the composite point of control. That market has rallied over the last couple of days and has found balance in a major volume area. The leader in the indices is the Russell, up 0.54%, 8.6 points, and is back above 1,600. The Russell enjoyed a real big pop on Friday, up 26.7%, and added 26.7 points, and added another 7 points yesterday. Real outstanding performance for the small caps, which have been kind of laggy compared to the blue chips. Basically, for the year, when the blue chips were pushing higher, the Russell was going sideways, and now it's catching up. The laggard this morning is gold. Gold is down $17.50, trading at $14.93.5. or down 1.15%. It looks to me like it is risk-on sentiment. The S&P is currently trading 3084. Yesterday's high is 3083. Yesterday actually had an interesting play in that it never took out the overnight high and low or low. Remember, that is like a 98% probability that would take out the extended hours high or low in the day session. Yesterday couldn't pull it off. I think it stopped two ticks short of doing that. So pretty interesting day yesterday. Very, very balanced. Ended up extending lower, but overall pretty poor action or price discovery. The market was completely imbalanced, liking these prices around the 30.79, 30.80. So that's where we stand today. Looking at what the theme is, the overall theme is for the market. We're still paying attention to the U.S.-China deal. There were some comments from the China Global Times editor. Again, this person has been very vocal about what's going on with the negotiation. He's stating that to have a deal, China and U.S. must simultaneously remove the existing additional tariffs at the same ratio, which means that tariffs to be removed should be in proportion of how much agreement has been reached. I don't believe the markets responded to that. That came out at 7:50 my time, 8:50 Eastern. Market really didn't care about it. But the overall theme is Brexit, manufacturing, and global manufacturing. The numbers that are coming out, of course, earnings are still going, and the U.S.-China deal. So that's where we stand currently. Looking at the calendar in terms of what is in front of us today, we did get some release. Whoa, what is going on here? We did get some releases already today. The balance of trade for the U.S. for September came in at $52.5 billion, right in line, negative $52.5 billion, right in line with what's expected. The deficit just bloating and accelerating this year. We do get 15 minutes after the open, we get the market composite PMI final, which is considered a lower tier number. At 10 o'clock Eastern, 9 Central, we get the ISM non-manufacturing PMI, expected at 53.5. This is an important release. There are others that come out with it. The IBD tip economic optimism, the JOLTS job openings, which are at record highs. These are jobs that have been open and did not that remain open and still need to be filled. The rest of the day, there isn't all that much. Fed's Kaplan speaks at 11:40 Central, 12:40 Eastern, and Kashkari speaks at 5 p.m. Central, 6 p.m. Eastern. That's about it. Let's take a look at what was expected yesterday versus what we got. The primary scenario yesterday was we would likely push higher, just tag the overnight high at 83.75. So we missed yesterday's high actually by 3 ticks, not 2. And then I expected responsive selling. Scenario 1 is selling. Scenario 2 is selling. I was looking for responsive selling in terms of an impulse down. Secondary scenario is a grind that just walks itself back towards the 30.65 high, but leaving it open, leaving a gap open before it rotates back up into the middle of the range. And so what we end up with is an island day. Again, I drew this arrow to describe that the trend is generally up, and we're expecting it to continue to be that way. Water flows down a path that is inscribed into the rocks until somebody disturbs it. So the trend, another way of saying that, and not so poetically maybe, is the trend is your friend. So this is what actually happened yesterday. Very few rotations, pretty poor price discovery overall due to the balancing nature of the market. But there was one opportunity later in the afternoon, and that was the pullback to 76 for continuation. I was looking for a break of 72.50. We ended up with a local double bottom here. So we have our biggest rotation of the day, the drop from 79.25 down to 72.50, pullback to mid, and developing value low. Was looking for a tag of 72.50, so we front run that by 2 ticks. The last low at 73, that gets filled, and then looking for consolidation and then continuation to gap mid, which was 30. It's actually higher, 30.70.50, I believe. So that's what I was looking for, but instead the market pushed up, which was in our scenario 2. Expected the market to push up and close up here, actually a little bit higher, and so the trade ran out of time. But other than that, it's pretty dull trade. Now, yesterday having been balanced, the Monday after NFP has this habit of being very quiet. Yesterday having been balanced, Tuesday is the highest range and volatility day of the week in general, historically. And having been in balance today might give us some range extension, range expansion, not extension. So we'll look for that. Balance is likely to lead to imbalance at some point, except that we are at all-time highs, which makes things pretty dull to look at. So overall, the delta and price were pretty much a match yesterday. We did have pretty good volume, 909,000 versus 1 million for the RTH session. So there's volume's been in line. If you look at the volume per bracket right down here, you'll see that the volume bars, the orange and white volume bars, are pretty much keeping up with the black lines, which describe the mean for that bracket over the last 20 days. So overall, volume's been pretty healthy. Surprisingly, I actually did expect the volume to kind of drop off the face of the planet in this kind of environment. In all-time highs, we expect volume to drop off, and we expect volatility to drop off, and so is the range. So we're getting the range and volatility dropping off, but volume's been holding steady. Here's what we have overnight. Really tight auction, tight trade. just about 11 or 12 points in range. And overall, very high kurtosis. Those of you who don't know what kurtosis means, just look it up. Kurtosis is the concentration of a sample of data. So this is a high kurtosis curve. This is a lower kurtosis curve. In other words, the value area is very concentrated, or the one standard deviation is very concentrated in this particular environment. It shows that the consensus is very, very high in a small range. And now we have to not only look at what price did, but we have to look at what volume went into it. Remember, price describes direction or acceptance, and volume is the thing that the important, equally important. Most people look at price but not volume, which really doesn't make any sense to me. Volume tells us how much of that they're accepting, how much of a certain price they're accepting, or how much of a certain consensus is occurring. So volume tells you the force behind that direction or behind that price. And so volume's been pretty good, pretty strong, and the value area is very concentrated, and it's not able to get and hold below 30.80. So you could see 30.80 holding as the mid currently. Multiple attempts to fall below 30.80 have been bought back up once the European session opened. So it's holding very steady. It's very, very coiled, in my opinion. Let's take a quick look. By the way, while it's coiling, Delta is rising. There's a more aggressive buyer since this pop higher last night. Here's what the overall picture in terms of Delta in terms of order flow looks like. We just took a little bit of a drop, just 4 points or so. If we scroll back and look at how this thing has traded throughout the session, come on, baby, load. Oh, it looks like I have a bad tick here. Need to re-download that. So the data. So let's scroll it back. So the bad tick is right at the open. Need to work on that. So here's the pop early on. Quite a bit of volume went off here. The VWAP of that pop is around 30.7950. And a fair amount of volume traded right there. A couple thousand. We came back. We backfilled a little bit the scene of the crime from this pop, which was down at 30.74. We pulled back to about 30.77, and then we've been sideways since then. We don't see a lot of clear liquidity distribution since then. We also don't see very much action in terms of discovery, and there's quite a bit of volume concentrated, or quite a few offers concentrated up above, more so than below. Yesterday's close, pay attention to yesterday's close. There's been liquidity here pretty much the entire session at 30.75, 50, 76. Seeing above 90 and 95. These are strike prices. The 90 coincides with the stock zone. That'll be an area I'll watch and trade into. This stock zone is based on a measured move because we haven't been here yet. And so is the stock zone above it. The big area on multiple confluences of a measured move is 107.50. 3,107.50. That's a big area up above, which is about 20 points away or so. So that's where we stand currently. In terms of liquidity and volume. We'll see how today trades. I have an admission to make, a confession, which many of you have heard many times before, and that is I'm not good at this market. This kind of market is kind of my kryptonite, and for that, I just sit back and I get really picky. It's really important, I think, to know where our strengths lie and where our weaknesses may creep up on us. And to me, a market that is in a low volatility rise is not a market that I'm very good at. And so knowing this, I simply chill. I look for, I look to trade more from the view of impulses, pullbacks on the side of strength, and that's how I focus on the market. I also turn into a kind of a medium-term scalper, as I don't have very good reference points. If I pull up my stock zone areas, you'll see that the stock zone areas above are not based on any reference from the past because we've never been here in the past. And so they are measured move based stock zone targets. That's what these are, the 85, 89, 92. And again, this big area up here, the 108. Other than that, it'll be a pretty blank slate up above unless we start to roll over and come back and fill this gap between 30.50 and 30.44. We'll see it here in the master levels. Unless we start coming back and repairing these areas, which gives me some sort of reference point to put on a structural trade and hang on for targets according to the lines or squiggles that I put on the screen. It really is kind of a scalp-ish market. I'm not a swing trader. I'm not going to buy and hold. That's not my game. So I focus on what I'm good at, and I know this is not the type of action that I'm very good at, and so I treat it very, very differently. So I'm not saying I don't have confidence in my skills. It's simply I'm simply aware of where my edge is and isn't. And my edge is not in this grind type of trade. And so, I look at other products, crude oil. You'll notice that FDXM is back on the screen, back on my radar. FDXM is the mini DAX. So I'm looking for thinner, poppier products to trade, and that's how I adapt to the circumstances. And I suggest you just know what your strengths and weaknesses are and play your strengths, press your strengths, and lay off your weaknesses. I'm not interested in donating money to the market. So here we are. We're on top of yesterday's value high. We are around yesterday's open. We are around the overnight point of control, which had a very high kurtosis, a lot of concentration in this area. I'm expecting an open that is an open auction in range, but an out of value, open auction in range, out of value. But I'm expecting this open to be pushed fairly strongly. I'm looking for the 30.80 to fail. Looking for a move back into yesterday's close at about 30.75, 76. And then I'm looking for a test of that low again. And then I'm looking for it to test out the 72.50, pop back up to fall back below and get into the gap zone below for a push down to 68.50. I'm expecting some selling to come in today. The news is fairly baked in. I know it's a risk-on type of environment, but I'm looking for the market to focus on retesting the areas that have not been auctioned properly. The alternative, scenario 2, is it opens and it squeezes higher, pushes through that 83, takes out the 85.75, gets into 87, 88, and then it impulses down back to the point of control, back to value low, and then stays up here and sideways for another whirl. Scenario 3, because again, we are at all-time highs, there are many things that can happen up here. Scenario 3 is an open that responds back to the point of control and then impulses back up, holds steady at yesterday's high after poking through, and then grinds its way into 30.90, where we have a liquidity pool here. So I look for it to punch, beat around a little bit, punch through to 30.95, and then to hold steady up here. That would be scenario 3. That's in line with a Tuesday range expansion. Those are the 3 scenarios. I am looking for the market to, because of how the action happened yesterday, it did not give up prices, but it did not properly test down into the gap. It did not push higher. I'm looking for some action, some expansion today. So be careful. But I'm also looking for a lot of the participants to be banking some profits, and the perma bears to jump back on this and try to get something going to the short side, at least temporarily. I would still lay off the shorts on a concentrated basis, on a structured basis. Really, the squiggles that I draw here on the short side are quite light and tight and tentative. I'm not advocating for fading the overall trend. Be smart now. Don't donate your money and then turn to me and say, well, you said short and I got short and I got creamed. Your trade is your own trade. As I've always said, trading derivatives is not suitable for all investors. If you're emotional, if you trade from the gut and so on, the futures market is fantastic at teaching you a lesson or wiping you out when you're not emotionally aware and your actions don't reflect your plan but reflect your emotions. If your actions reflect your emotions, you're going to pay. But if your actions reflect your plan and your edge, then you're likely to do better, in my opinion. I'm not saying it guarantees success, but you certainly have a better opportunity to achieve it. Oh, it reminds me, I put this image up on Twitter. I'd really like you to read and consider this. This is really important. This is something you come to after being a seasoned trader. You start to recognize that I can't be invested or frustrated or angry at the market, because it just means when there's frustration at the market, it just means that we're projecting what we want it to do, and it's not fulfilling that projection. We don't make money projecting what we want. We make money aligning ourselves with the market. Remember, we are surfers like those in Australia and California and Hawaii. We're surfers. We don't make the wave. We just identify it and ride it to the best of our ability. That's our goal. And we always have a cost to win. There's a price to win. Instilling emotions in your trading really is a very costly way to do business. So when you see things that aren't going for you, it's the actions you take that save or preserve you to fight tomorrow. And if we can't fight tomorrow, the game is over. Good luck.